Good evening. My name is Peter Riddle. I'm the Director of the Institute for Government, and welcome to the third in our series of 4 events on the business, the city and government, which we're doing jointly, sponsored by and in partnership with the City of London Corporation and also with the FT as media partners. And if in case anyone, which is rather unlikely given this audience, hasn't seen today's FT, we do have a pile of them. I think in this world of immediate communication, it's slightly odd 8-9 hours after the FT's appeared to have one. But anyway, if you haven't, it's out there. If you value written paper, as next FT man myself, they're there. Now, before I formally introduce Paul Tucker, who I'm delighted is our speaker this evening, I'd like to invite Mark Boliat, who chairs the Policy and Resources Committee of the city, to make some remarks. Mark, in fact, was involved very much with the whole programme we've been having and chaired our second event, which was a workshop on interchange between the private and public sectors. Mark.
Thank you, Peter. A very brief word from the sponsor, and indeed your introduction of who I was is about half of what I wanted to say. The city really is indeed delighted to be sponsoring this programme. It's really important now more than ever that business and government understand each other. Tonight's event is very timely, talking about the new regulatory structure. It's now been in place for weeks, and how it works in the future is going to be vitally important to the city. The title itself recognises that there is a trade-off, something which is not always recognised in the political debate. There can be a number of competing objectives, and there's always a trade-off between them. So the bank has got a huge task in the years ahead, and that is complicated by what is happening in Europe. And we do, of course, have a fierce political debate about the future of Europe, renegotiation, repatriation, referenda, and so on. But in the short term, it's really important to continue with the day job. I have the opportunity to talk to many city institutions, and I'm getting a very common and consistent view from all of them. That is that Britain needs to be in the single European market, at the heart of the single market, fully engaged, better engaged than we have been in the past. And it's important not to lose sight of that in the more politically exciting debates that we're going to have over the next few years. We have seen in the past few months some good examples of where Britain has been very successful in its negotiating stance, for example, in the agreement on the European Banking Union in December. But we haven't always been successful on everything, and the banker bonus issue is one such point. And there is perhaps a lesson from the Eurovision Song Contest here. It is important not just to have the best performance, you also need the votes. And that's not something we can necessarily expect the regulators to do, but it's a task for the politicians. That's quite enough from me as a word from the sponsor. Can I now hand back to Peter?
Thank you very much indeed, Mark. For a moment there, I had a real fear you were going to invite me to sing. Nothing would have emptied the room faster. I went to an audition which lasted 10 seconds. Certain members of my family think that was 5 seconds too long. Paul Tucker, I've known Paul since the mid-80s. I was asked by the BBC to do a radio programme on, it was called Pillars of Society, British Institutions. And amongst those I interviewed were the up-and-coming members of the Bank of England staff, along with the great leaders of the bank at the time, and so on and so forth. So I first knew Paul then, and we've known each other ever since then, as he's risen in eminence as a career Bank of England man, particularly on the regulatory side. I won't list the variety of committees he's involved in, both at the bank and, of course, internationally, because he plays a big international role there. But he's also one of the most reflective people on the position of the bank, and that's particularly why I wanted him to speak as part of this series, because he has thought about the bank's position in relation to Whitehall, to the city, to business and to society. His title is A New Regulatory Relationship, the Bank, the Financial Sector and the Wider Economy. And I think what we'll hear from him is not the details of capital ratios and things like that. Indeed, I specifically said to him this wasn't the audience for that. But what it is for looking at the wider relationships, because the bank is inescapably part of those wider relationships, which it wasn't in the past. It was a very different world when I was a financial journalist, when it really was the governor's eyebrows, and the particular governor in the late 70s, early 80s did function by eyebrows, if those could ever be communicated down the phone line, which they often were. Now we're in a very different world, and a world of transparency, a world where regulations have to be thought out in a very different way, notably following the events of 2008, 2009. And Paul's been at the centre of that. And therefore now I think it's an appropriate time to reflect on that, particularly in relation to the series which we now have, looking at the relationship between the business, the city, government, and the wider society. Paul.
It's a measure of the turn of the weather, I think, that there are so many people in this room. Thank you very much for giving up your time. Thank you, Peter, for inviting me to be here. It's been impossible to be in the Bank of England over the past few years and not reflect on not only our changing role, but the way that shifts us in relation to the wider society. By no means just the city, but every bit of society, and perhaps especially Parliament, to whom we are accountable. As Peter said, I'm not going to say anything technical at all, I hope. It will be a mark of professional malady if I slip into that. You can point it out if I do. I thought I'd say something about three things, starting micro, then going through macro, and ending up global. The first is about our relationship as a regulator, supervisor of banks, and the role of rules and discretion in that. The second is about our role as macro policymaker, which touches everybody in our society and wider than that, and the role of transparency in that relationship, that function. And finally, how almost everything we do, especially on the financial stability side, has a big international, indeed a global dimension, and the challenges that brings in terms of explaining what we're doing to the Westminster Parliament and to UK society. So the first part is about our role as regulator, role as supervisor, again, of banks, this time not only of banks, building societies and insurance companies too. And an awful lot of it has been said, rightly, about how this will not be tick box, and it won't be, how it will be judgment based. And that, on the whole, has been applauded throughout the financial community, in particular by the banking community. But it's hard not to pause and reflect on that, in particular contrasting, because Gordon Richardson would have felt comfortable with judgment-led supervision. I suspect he would have paused over the hyphen in judgment-led supervision. He'd have wanted a slightly longer sentence, but he would have recognized it, and that almost goes to the heart of the issue, both in terms of whether or not the city really will embrace it and how we should deliver it. The city and the wider financial community say that they're pleased that it won't be tick box. But it's hard not to remember that at almost any point over the last 20 years, I would say, in which a particular public policy issue in the regulatory sphere has come up, the call has been for certainty. Certainty based on rules. And yet when the leaders of the same firms see the resulting rule book, which I'm told rises towards the ceiling, they don't like the inevitable result of tick box supervision. Nor, it could be said, are they consistent in supporting a judgment-based approach and at the same time having at least acquiesced in endemic regulatory arbitrage by the middle and lower levels of their firms over the past 20 years in finding their way round the rule books, and particularly in the United States, but also in the City of London. A good deal, not all, but a good deal of the problems that gave rise to the current crisis manifested themselves in navigating around the rule book. And so let me bring you back to prudential supervision. This is very different from rules. This is not securities regulation as traditionally understood. A securities regulator writes a rule book, checks compliance with the rules. If the rules are breached, punishes those breaches, even if they've concluded the rules weren't very good, but the rules need to be enforced for the integrity of the regime, and later on the rules get improved. Prudential supervision isn't like that at all. Prudential supervision is about assessing the financial health of firms. It's about assessing the competence and professionalism of the people that run, lead, and manage those firms. It's not something where you could write down a complete rule book or indeed an approximation to it. There isn't a rule that will capture completely the capital adequacy of a bank. I'm reminded when one sees capital adequacy rules in capital adequacy indicators, ratios in rule books, I'm reminded of monetary aggregate targeting 30 years ago, trying to encapsulate the whole of the nominal regime in a simple rule about a narrow monetary aggregate or a broad monetary aggregate, and it failed because the rules were crude, not because the commitment to price stability of the writers of the rules was flawed. In prudential supervision, measures of capital adequacy or liquidity adequacy are indicators, not rules. The kind of questions that the prudential regulatory authority will be putting to management from time to time. Your bank isn't as strong as you think it is. Cut back on the risk in your book. I'm afraid you're not fit to run the bank. Your business could not be resolved in an orderly way if it fails. Gordon and Robin would both have recognized those sentiments, and so would Eddie. And Mervyn shares them today, and I'm sure that Mark will too. But it poses the question about whether our society is truly ready, will embrace that judgment-based approach in today's world when we use those powers in earnest. Now, I've set this up in a way that poses it as a challenge, and the solution, of course, in part, is public law. When we use our statutory powers, we must follow due process. Both through we are subject to judicial review. We can be taken to appeal tribunals. That is a quite necessary and strong constraint on what we can do. There will not be the arbitrary use of power, but nevertheless, it will be very different from trying to enforce a rule book. But there's another challenge in this area, which will take me to the second part of my remarks, which is how in the years of calm, and there will be years of calm again, or at least of apparent calm, when some new crisis is brewing under the surface, how in those years of calm can society, can Parliament see what we're doing and hold us to account, and in a way that is harder than what I've just been describing. So this brings me to the macro functions of the bank, the truly central functions. Remember that we're charged with preserving stability in the value of the currency, the internal value of the currency, and stability in the financial system. These are medium-term goals, and they require a medium-term perspective. But what the operator of those regimes does affects the course of the economy in the short run. Now, on the one hand, that's why these roles are given to unelected people like us, so as to solve what's known as the time consistency problem, so that what we promise today is what we will deliver tomorrow, so that we won't be deflected by other objectives. But on the other hand, it poses the question of how unelected central bankers manage the short-term trade-offs, how society can monitor that, and how society can satisfy itself that we're not deviating from the medium-term goals that we've been given. Now, this is a familiar debate in the monetary sphere. It's occupied a great deal of the past quarter of a century or more. And I think it's fair to say that most advanced economy societies feel that they have cracked that problem big picture. There is typically a quantified, well-defined medium-term target. It's 2% for CPI inflation in this country, and transparency. And I was reminded the other day that we now take transparency in the monetary sphere so much for granted, yet it is less than 20 years ago that the Federal Reserve did not even announce what its target interest rate level was. It had a target for the overnight interest rate, but it wouldn't reveal what it was, let alone how it had come about deciding what that rate should be. This isn't the biggest issue of all on the monetary side, in fact. We're in the business of creating time. We smooth adjustment. We can't make the adjustment when more profound adjustment is needed, whether that's by households, firms, or governments. We make it easier in some respects to make the adjustments, but we also make it easier to defer the adjustments. And our responsibility is to do no more than nudge, to stay within our remit, to explain the economics as we see it, but not to hector, and obviously not to take other policy decisions, except in the area now, again, of banking, where we are faced in this country right now, and not only in this country, throughout the Western world, with a need for our banking systems to adjust, to strengthen themselves, and that's precisely what the new Financial Policy Committee has been pressing the banks to do, on the basis that a sound banking industry is a necessary condition for sustainable recovery. Now, this represents the first significant intervention of so-called macroprudential policy, a neologism for something that existed in the past but was put aside for perhaps 20 years. You can think of the Financial Policy Committee as an institutional device to ensure that the importance of stability is not overlooked again. That as the monetary policy makers do their thing and the micro supervisors do their thing, that the bit in the middle, which is the stability of the financial system as a whole, doesn't get neglected. And looking ahead, rather than to today's challenges, looking ahead, part of the FPC's role will be to keep the regulatory regime up to date as the financial system evolves. Technically, what that will involve is making recommendations to the Treasury. And then crucially, when the time comes, as eventually it will, taking away the punch bowl. And of course, as soon as you think about that role, taking away the punch bowl as the party's getting going, a moment in which the various alignment of the forces in our society will be rather different from now. I predict that bankers and public and politicians will be on one side and the central bank on the other side, that almost makes the case for operational independence in this sphere, just as in monetary policy, an independent central bank. But it also underlines how important it is to have a clear objective in this so-called macro-prudential sphere and to have transparency. The legislation that has introduced the Financial Policy Committee is clear that the primary objective is the resilience of the system as a whole, but that we should not, must not, aim for the stability of the graveyard. crucially, unlike the monetary regime, this resilience is not quantified. So far as transparency is concerned, we're told to publish the record of our meetings, and we are told to continue to publish our twice-yearly financial stability report and to put more in it than we have in the past. Now, if you put that together, there's a question about, well, so how can we ensure that society can see what is going on while respecting the confidential data of individual institutions? And really, that's the backdrop to the FPC having recommended to the bank. It can make recommendations to the bank as well as to the regulators, that we should develop a regime of stress testing for both macro-prudential purposes and micro-prudential purposes. And I see this as one part of a broader effort that government as a whole needs to deliver, where the vulnerabilities of our economy to bad shocks should be assessed and measures to strengthen the economy taken from time to time. Now, there are two things to say about these stress tests in the future. One is they may help us quantify the degree of resilience that the financial system should have, because everybody will be able to see that if we believe that the financial system needs to be able to withstand a stress defined as X and Y, but not one of A and B. And it will be open to Parliament to come back and say, no, you got that the wrong way round. That's not what we meant. We meant something else. And whenever I say Parliament, I mean the executive branch as well. And I think that'll be a healthy thing, where over time we are able to put quantification around the goals of financial stability. But the other part of it is transparency. If you look to the United States and elsewhere, the results of stress tests have been published, and firms have from time to time failed them, or even if they've passed them with greater or lesser success. And that is just like the business of moving back from rules to judgment. This is a step in the opposite direction, if you like, to much greater transparency in the assessment of the financial system, and not one that I suspect that the financial system will welcome every day. But this has been a precondition on Parliament's part for giving us these powers, and it shouldn't be forgotten that neither the markets as a whole, investors nor the public, felt comfortable with the secrecy of the past. But it poses a question which will take me to the third part of my remarks about what happens when a firm fails the stress test, when it's revealed not to be resilient to whatever the Bank of England thinks is coming down the tracks. And at this point, it is just impossible to stay domestic. At this point, we have to turn global. And that should be easy for us. We're a country that believes in free trade, open financial markets. As a result, for hundreds of years, our financial system has been highly integrated into the global system. And that means that the firms operating here or domiciled here want a level playing field. They want to be able to compete on equal terms with indigenous firms elsewhere in the world and with other firms from other international firms competing elsewhere in the world. And that's common to the authorities and to business. The extra bit for us is that we want the level playing field to be based on good standards. And that's not just because we want good standards at home. We, of all countries, desperately need good standards abroad. The UK's financial system is so interlinked with the rest of the financial system that, as I've been saying to my colleagues for well over a decade, probably 2 decades, somebody only has to sneeze somewhere in the global financial system and it echoes through Lombard Street or Canary Wharf to a greater or lesser extent. There's no financial autarky for this country. We're the opposite of an island when it comes to the financial system. We have a greater stake in global financial standards than perhaps any other country in the world. And even after the government's ring fencing of retail banks has been implemented, which can insulate our purely domestic financial system in degree from the global financial system, even then, the non-ring-fence banks, or the non-ring-fence banks, part of the wider groups, will be exposed to the global system, and so we can't leave it just as ring-fencing as the end of the story. So far, so good. The business community and the people like me pointing in the same direction. International level playing field based on good standards. But there are two problems, I think, with this, two challenges. The first is the business sector is understandably frustrated with the time it takes to develop and agree those international standards. And it takes longer than in the past. 25 years ago, when the first Basel Accord was agreed, I think I was the most junior Bank of England person on a team of 4. It was agreed by maybe 5 central bank governors, maybe 10. Only central banks in one room in Basel. It was all pretty quick. Well, today it's G20. With capital markets, it's not just central banks, it's securities regulators. In the intervening decades, we've realized that the political and social issues are so great that finance ministries need to be at the table as well. And so we arrive at a Financial Stability Board plenary meeting with over 70 people there, and those 70 people need to be carried to a greater or lesser extent. By prioritizing an international level playing field on one with good standards, we sacrifice speed, and that's a source of frustration to business people as they wish to decide their business model and plan their strategy. The other effect is quite different, but also relevant to our country in particular. It means that some of the key policy discussions end up being taken away from home, away from the Westminster Parliament, mainly global. In fact, now the process is pretty transparent. There are consultative papers published on just about everything. There are speeches, there are press conferences. It is easy to find out what's going on. It's sometimes easier to find out what's going on in international discussions than in narrower discussions. But an observation I have is that these global discussions are rarely covered as much in the media in any country, including the UK, but not especially the UK, as one might expect. Which poses, and one can't make newspapers and blogs and commentators cover things which have great medium-term importance, but which aren't part of the swirl of the local policy debate. We just have to keep on being open and available. But there's a deeper question here, and in many respects it's the most difficult question of all. In the monetary sphere, it's well known, and it's been well known for decades, that you can't have free capital flows, a domestic monetary target, and a fixed exchange rate. You can't do all of those things at once. So we have floating exchange rates on the whole. That's the solution to the so-called trilemma, or it's the solution that Western society is adopting for now, I think rightly. But there's a trilemma on the financial side as well. It is impossible to combine cross-border banking and an integrated international financial system. 1. 2, financial stability. And 3, national policies focus solely on domestic stability. That doesn't work. And the dilemma, of course, the problem here is that, as Mervyn said at the height of the crisis is that the big global banks have been international in life, but national in death. Now, the solution to this, as I've made clear already, is not financial autarky. It has to be cooperation and coordination in the way that we resolve distressed giant institutions. We shouldn't try to make them too safe to fail. We should make their failure, orderly failure, possible. And as soon as we take that route, it means that we're in the collaborative business for good, that foreign countries have a stake in the stability of our banks and vice versa. It means that the key policies are unavoidably international and global. It means that they're unavoidably cast to some extent at the global level rather than at the domestic level. And as a trading nation, we should welcome that, but as officials, we should ensure that our society understands that at every step and supports it or not. This country's reached an interesting place if you're a central banker. For the first time ever, the traditional functions of the central bank for financial stability have been put in legislation. I regard that as a thoroughly good thing, and I hope that the functions of the Bank of England can remain more or less stable for a quarter century, unlike the chopping and changing that I have lived and worked through over the past 30 years. But whether or not that's the case, we need to be clear about what we can do. We need to be clear about what we can't do. We need to be clear about how we're trying to do it. And above all, we need to be as transparent as we possibly can so that you can see what we are doing. And for no institution is that more important than for the central bank. We are in the business of trust. For you to trust us, we need to warrant that trust by you seeing what is going on behind our curtained walls. Thank you.
Paul, thank you very much indeed. That was absolutely fascinating. Before opening it up to questioning, could you just pose a few points? I mean, which you've experienced, you say the chopping and changing of the last 30 years in various ways. When you're doing your MPC hat, it was, until 2008, fairly straightforward. You had a target. You and the other members of the MPC, chiefly the governor, but other members, were accountable to Parliament. Even with a new regime, it's going to be much more difficult for the FPC to be accountable because less clear-cut, as you say, you yourself have said, much more complicated targets, also the international dimension. At least within the target the MPC's had, it's been a national target. However, it's been influenced by international factors. How do you reconcile that in terms of accountability?
It's first of all, you're right to say that this turns out not to be very hard on the monetary policy front. The way I like to put it is, if you read the legislation on the Monetary Policy Committee, and you read our quarterly inflation report, and you read our monthly minutes, and a couple of speeches, one of our books on the models that we use, you probably know as much about what we're doing as we do. It's all on the surface with monetary policy, whereas what we can't do with financial stability is turn up in front of the select committee and talk about Bank X or Bank Y specifically. Hence the point about stress testing. I think that the Americans in particular have found a way through this of framing a stress test and then stating publicly how well particular banks have done under those stress tests. Now, this is a virtuous circle thing, actually. You're best launching that kind of approach once you've got to a position where your banks are pretty resilient, or if you're absolutely certain that you can cope with the fallout if they're not, which was the path that Tim Geithner took in the spring of 2009. And it was really the American stress testing that brought the crisis at its worst, the first chapter of the crisis, to a close. So I aspire to being able to provide, if you like, some structured transparency around this, but without ever suddenly tipping into the public domain the innards of particular banks. That would be quite unrealistic.
What about in relation to the other partners, the Treasury? Because you say this is legislation, it's legislation which the Treasury has taken through. There is a clear, I mean, you say there are accountabilities under legislation which the FPC has. Again, they're more complicated because up till now, it has been one of the mysteries of the city. Up until 97, it was something which came under bank, and then it went off in a different route, and now it's returned. That, again, complicates the relationship because the Treasury are at least the primary source of political accountability. Even if it's select committees now, you have a parallel one.
Well, I think I'd say two things about the role of the Treasury. The first is that the Treasury has a very special role that only it can play in partnership with the Select Committee in ensuring that the framework works. I mean, they are the people who are meant to step back and say, does this architecture work? Is it delivering what we said it would deliver? Where is it flawed? That's the role of the executive branch of government. The other special responsibility that they have, inalienably, is public funds. And we probably have a richer framework for that in this country now than ever before, and I could have talked about this. Under the new legislation, where the governor of the bank thinks it's likely that the Chancellor may have to spend money in propping up the financial system in some way, and the use of public money is very broadly defined for these purposes, the governor is duty-bound to notify the Chancellor. Where that condition is met and it is judged by the Chancellor that there is an extremely severe threat to financial stability, the Chancellor can tell the Bank of England what to do with our own, well, not quite with our own balance sheet. It can tell us what operations to conduct, provided that there is eventually disclosure to Parliament about that. And in fact, the operations would be conducted in special vehicles, which we would run, but would be indemnified by the government. And so this knotty problem of when the banking system falls apart, will the Treasury have to pick up the mess? And does that mean the Treasury should be involved day to day in supervision? We've tried to solve that by putting in a threshold, an amber light, for when they are bound to be told what's going on. Now, broadening from there, we have just got to build a world where the stability of the banking system doesn't depend upon a fiscal backstop. And I alluded to it this evening, but I've talked on many other occasions about how the international community really does believe that the resolution of the biggest and most complex banks can be made possible essentially by putting losses onto bondholders rather than onto the taxpayer. The losses always have to go somewhere. They should go onto the creditors of the banks rather than onto the taxpayer.
You mentioned, I mean, also, I mean, you created Mervyn's phrase about in life they're international, in death they're national. But what about political accountability on an international scale? You again mentioned, from your early days of going to Basel, there'd be a tiny group of you, but now the finance ministers are involved and so on. How does that ensure the proper political accountability internationally?
Well, there are two. Well, we are public officials from nation states, or in the case of European Commission officials and the ECB, from European organisations. We need to be accountable to our Parliament about what we do on these occasions, which is why I laboured the point that what we do in the Basel Tower or the IMF or anywhere else is pretty transparent. It's at least as transparent as what goes on domestically. And I would greatly welcome more interest in that work. And actually when Mark comes, because he chairs the Financial Stability Board, I somehow think that London will gravitate to being more interested in what goes on in the international sphere.
But isn't there, I mean, inherent, because of the complexity of it, it is much more difficult. Inflation targeting, going back to the, as you said, incompatibility, which we eventually discovered between various targets of having a fixed exchange rate, domestic monetary targets, and so on and so forth, which we painfully discovered during the 80s. So you can't have everything, with lots of blood and tears during that period. But isn't one of the problems that when it's come down to it, particularly post the 1992 regime, when we had inflation targeting coming in, some people could comprehend. However much it was broken or whatever, it was an intelligible thing. One of the problems is, as you said, complaining about the level of media coverage, a lot of this is way beyond most people's comprehension.
I'd say two things about that. Probably the second is the more important. The first thing is that you're right. There is a beguiling simplicity to the monetary policy function, and one mustn't overdo it, but it lends itself to simplify communication where you're not sacrificing the core truth. Whereas on the financial stability side, it is multifaceted, multidimensional. It's partly about capital markets, it's partly about banks, it's partly about resolution, it's partly about capital, it's partly about liquidity. There isn't just one instrument that you can communicate on. Now that means that we need to explain all of that as clearly as we possibly can for a professional audience, including the select committee. We also need to find, this is the second point I would make, is that we need to find ways of communicating with the general public about this. But it's a quite different challenge from monetary policy and inflation. And in this respect, it's a bit easier. So if you go back 15 or 20 years, one of the things that we talked about in the bank, and Mervyn was very much in the lead on this under Eddie, was we had a campaign for price stability. We wanted to help convince the country that inflation was a bad thing, that price stability was a good thing. Well, no one in the country needs to be persuaded that failing banks are a bad thing. The objective of financial stability is not something where we need to go into the pubs and clubs and battle away to persuade them that there's no great advantage in that. It's not like a little inflationary boom which feels quite nice when it's happening. The objective, I think, is easy enough to communicate, and that's a great starting point. The hard bit is, which we haven't cracked yet, is how to pare this down into a few simple messages about what we're doing that don't become oversimplistic to the point of being wickedly misleading.
Isn't one problem also that the 2008 chapter hasn't really yet been closed? That it has, you've created a new regulatory framework, or the government and you have now come into force, all that. But in a lot of the minds of the public, I mean, viz the Tari Commission now, the chapter isn't closed, and that makes it difficult to move on in that sense.
Of course it isn't closed. You and I have probably talked about this before. In my view, it won't be closed until the economy as a whole has healed, until employment has got back to more or less where it should be. Unemployment has come down to more or less where it should be. And I mean, I think that bankers and others in the financial services industry around the world, as much around the world as here, have been slow to appreciate that the debate about regulatory reform will not go away until the economy as a whole is healed. A kind of problem with that, of course, is that until the economy is healed, no one will actually know just how terrible the damage caused by the crisis was. We know that it was terrible. We know that it must do our best that it doesn't happen again, but we won't know for some years yet just how terrible it was, how much activity have we permanently lost. Can we catch up back onto the path our economy was on before this terrible crisis hit. And that's actually a rather profound problem in designing a new world, because you don't know just how great the costs were. You simply know that they were big.
And then just before opening it up, one final point, which is, in a sense, going back to when I first covered the Bank of England in 35 plus years ago, there was a mystery. Interest rates were decided completely, conversations between the Chancellor and the Governor. I was in the privileged position of being economic correspondent at the Central Times. I would have a call on a Wednesday evening, and we'd have a wonderful discussion about which way things were moving. Might up a bit, 1%, yes, maybe. And these discussions carried on, which sound completely absurd nowadays. But there was a sense of mystery about central banking. I mean, a bit akin to the intelligence services before they became avowed in the late 80s, early 90s, and even then more selectively avowed than you are. But moving to becoming public figures from private figures, how does that, and when you're not politicians, when you, as you yourself said, you're unelected.
Well, the mystique has gone, thank God. In some respects, I think the mystique was a product of decades where monetary policy was not the principal macroeconomic instrument, where fiscal policy was adjusted regularly and was the principal instrument, and monetary policy became this mysterious thing in the background that somehow managed the markets. I think we're much better off with monetary policy being the primary tool of cyclical demand management. And as I said, we can be transparent almost completely about that. But it does bring to the fore the point you make at the end. Yes, we are unelected. It means that society needs to frame our objectives as carefully as it can, which means Parliament and the executive branch of government, and regularly hold us to account. And somehow square that with being independent, which isn't easy. I was in one select committee appearance where it was said with some feeling, a legitimate feeling, well, you call this accountability, but you come along as a group and we make various points to you and you explain why you've done what you've done, and then you go away and you carry on doing what you were going to do. And there's a kind of profound point in that exchange, which is that the Parliament creates these regimes and they persist at Parliament's pleasure. But so long as Parliament has given us the responsibility of independence, then that is something that we should stick to and not try to second guess the fluttering of the winds and stick to our medium-term goals. But Parliament can take that independence away on the advice of the executive branch of government, and that's something that has happened before, and I suppose it could happen again.
Right, let's open it up to questions. Could you say who you are? We got there are some familiar faces, but also some unfamiliar faces too. So could you say who you are? And I'll probably group the questions. I see the gentleman there. Kerry. Yeah.
Ben Chew from The Independent. A couple of banks in which the government has a stake have recently announced that they're not going to be raising any more equity capital, somewhat contrary to expectations. This has been interpreted in some quarters as a rebuff to the Financial Policy Committee's call for the sector to raise more capital. Is there any truth in that? And how confident can we be that the FPC has the authority and also, importantly, the political backing to make the financial system safe?
Right, okay, the gentleman just in front of you there. Yep. Yes, hold on, if you wait for the mic.
Chris Bates from Clifford Chance. I wanted to ask a question about Europe and relationship with Europe. Two questions. One is that you talked about rules versus discretion. An awful lot of rules in Europe. I mean, and coming to Europe, which, I mean, I was reading them the other day. It's about 2,000 pages.
You probably know them all, actually.
That's great. But I mean, you know, it isn't possible just to ignore them. And one of the issues in terms of interpreting the rules is the role of UK authorities versus European authorities. And the second question, just like to comment on in that connection, is the relationship with the ECB and banking union, in the banking union context, is that, you know, with the ECB being the sort of granddaddy of all bank supervisors in assets under supervision, how important will that relationship be, and how do you see that evolving and influencing or not influencing the way the UK conducts its supervision?
Right, let's take these two and then move on.
Well, on the first one, I'm not going to comment on individual institutions. The FPC certainly has the authority. It was given the authority by Parliament. So does the PRA. It was given authority by Parliament as well. We've made public statements on that. On Chris's questions about Europe, there is an interesting thing about Europe here, which is that, well, there are lots of things, but I'll pick out one. Unlike most other jurisdictions, for example, the United States, the EU puts things like capital ratios in law so as to ensure that they are applied across the 27 member states. I nevertheless think that that should not deflect us from what I said about using these as indicators. What I say to, I mean, Andrew Bailey runs, in executive terms, he runs that part of the bank. I sit on the PRA board with Mervyn and others. What I say to all the supervisors is, when you see a bank with a capital ratio that is higher than the legal minimum, ask yourself, what is the capital adequacy of this bank? And when you see a bank with a capital ratio below the legal minimum, ask yourself the question, what is the capital adequacy of this bank? And we very carefully, and the Treasury and were immensely supportive in this, we've reframed what are known as the threshold conditions for authorization as a bank in the legislation. And this was reviving an approach from 20 or 30 years ago. The key bit of banking supervision in this country are the statutory criteria for being authorized. And they are again framed in common sense English rather than incomprehensible English, which is, I'm afraid, what happened in the first FISMA. And they say things like, you must have adequate financial resources, including capital and liquidity. You must be run well. You must be prudently managed. I was particularly keen that that expression find its way back into the threshold conditions. And those are the supervening criteria. There is a European rule book, but ultimately we have to decide whether banks are authorized or not, whether our powers are exercisable, and whether our powers are exercisable depends upon the threshold conditions. And something else we did in the statute, which is worth mentioning as well. For the first time, and this is not an echo of the 79 or 87 Banking Acts, Parliament has decided that the objective of banking supervision is the safety and soundness of banks, which is an expression imported from elsewhere in the world. But the legislation goes on to say what is meant by safety and soundness, and it means that the way that a bank conducts itself does not damage the rest of the system, or if the bank fails, that the way it fails does not damage the rest of the system. And I think all of those things put together, the objective of the statute and the threshold conditions, the reframing of the threshold conditions back into English, will be a great help to us in addressing the particular issue that you raise. The second point you make, Chris, about the ECB, we completely agree that this is of first order importance, and we think it'll be a very good thing. We think the relationship between the Bank of England and the ECB will be immensely important in the area of stability. I mean, big picture, there are going to be 4 big supervisors in the Western Hemisphere: the Bank of England, the ECB, the Federal Reserve, and the Swiss. Now, as the years pass, there'll be very important supervisors in Asia and Latin America, and one hopes one day in Africa as well. But in the West, there will be 4, and that is easier than a score or so. It does mean that as Europe proceeds towards banking union for the 17, that the single supervisor really should be a single supervisor rather than a committee of national supervisors. Now that's not something that we can control or even influence much, but it is something which this country has a fairly profound interest in.
Jonathan. Lauren, here.
Jonathan Portis from the National Institute of Economic and Social Research. Well, I remember about 3 or 4 years ago when we were both dealing with this that I was shocked by reading that Barclays had somewhere between 2,000 and 3,000, the Barclays group was composed of somewhere between 2,000 and 3,000 separate legal entities, most but not all, of course, headquartered in the Cayman Islands or similar, generally for perfectly legitimate reasons, I'm sure. But you earlier, let me be clear, I'm not asking you to talk about Barclays specifically. I'm going back to your point saying that the international community is convinced it can make ensure that every institution can fail and be resolved sensibly. Do you, or does anyone else in the bank know how many legal entities Barclays or any of these other big banks have now? And more importantly, do we really have any confidence that regulators, no matter how good you are individually, can possibly get your heads around the type of organization that we're talking about without considerably more radical reform than we've seen so far?
Thank you for that.
And question there.
Sorry. Thanks, Peter. David Clark. I'm a bank non-exec and an IDB non-exec, and I chair the London Wholesale Market Brokers Associations. Paul, it's a slightly different question, I'm afraid. It relates to risk and stress testing. If my recollection is correct, and you were on the Basel Committee for Basel II, I'm sure you didn't write it, by the way, but
I wasn't involved with Basel II.
I know you didn't.
He said
Bill,
defensively.
Donna and Howard announced Basel II as being, here's Basel II, it is not our intention to increase the amount of capital in the system to handle the amount of risk in the system. That's what the press statement said, and it was probably quite right at the time. That is not certainly the mantra at the moment, and your comments on stress testing and the Fed, I think, were quite judicious that you made earlier on. My question is, I think the question is more about risk than capital. They focused on the amount of capital to handle the risk. My question is, have we lost focus on the amount of risk that we need to actually run the system with? Because we're looking at capital ratios that take into account the risk that banks are running, whether it's 9.5, 10, 10.5, 11, 12, 13, 14%, depending where you count it, is about the risks that currently exist. What about the risks, the financial risks, that growth in society need? Is that a concern for you?
Two very different points.
Absolutely. So on the first one, and you have to shut me up if I get too techie at this point, and I will promise to send Jonathan all my speeches on precisely this. So there are 2 types of resolution strategy. One is called single point of entry. The other one is called multiple point of entry. I'm going to focus on single point of entry because of the top 20 firms in the world. I think the consensus is that it would be that would work for most of them. And I'm not disagreeing with you that there needs to be simplification of the innards of these firms, but the way single point of entry works is that wherever in the group the losses occur, they must be pushed upwards to the top of the firm, to the holding company. You then have something like a pure holding company with equity and bonds, and you then do a capital reconstruction of the holding company. All the losses are now in the holding company. You write down the equity until, if you've still got some losses left over, you write down the bonds until you've absorbed all of the losses. At that point, whatever's left of the bonds, you convert them partly into equity, and you've recapitalized the firm. And there'll be plenty of people in the room that recognize that as a 32nd version of Chapter 11 applied to banks. Now, there are lots of technical things that need to be done on the way, and many of them are being done. But the way through this is partly to simplify the innards of groups, and it is partly a broad, well, not broad brush, but a simple idea that has to go laser-like through these firms, because I'll mention one of them. It means that the holding company can't just be exposed as to the amount of its equity. It basically has legally to stand behind the obligations of all its subsidiaries, which stands 30 to 40 years of bank supervision doctrine on its head, but necessarily so. In response to David, the capital markets are going to become more important. I mean, I think that will be true on the continent of Europe as well. I think if there's one big risk in this conversation, it isn't that bank capital adequacy is neglected, that's obvious. I don't think it's even that growth is neglected. I think one of the advantages of having supervision in the central bank is that you can be damn sure that central bankers are going to be attentive to the growth implications. But the risk, the thing that could get lost is that we need to ensure that our capital markets are sound and effective. More will be done by the capital markets over the next 25 years rather than less. And that means that securities regulators will be as important to stability as prudential supervisors. And in fact, we've tried to set up the new UK structure in a way that binds the securities regulator, the conduct regulator, into the stability agenda. I mean, I think that in many respects, that is the most interesting thing we have done in the new architecture, and the least remarked upon.
Right. Sorry, just one question at the front, then I'll move to the back.
I was interested to hear about George Shaker from the London School of Economics. I was interested to hear several times you saying government, parliament, executive branch must hold us accountable. But you haven't quite specified what that means. I interpret that as saying the markets no longer can be seen as these judges that hold us accountable with risk premia and things like that. But, you know, Mervyn King writes now a letter every month explaining why the inflation target is not met that has been set for him. So do you suggest that he should be fired?
Right, why don't we take that one and then move back?
Okay. Actually, I'll take the opportunity to make a small point about the letter writing process. So in case anybody in the room has forgotten, if inflation goes above 3% or below 1%, the governor of the bank has to write to the chancellor saying why this has happened and what we're planning to do about it. And that's very good. And I was part of a group of 4 people. I think it was probably Mervyn, myself, Alan Budd and Stephen Pickford that kind of designed that part of the system at official level. The difficulty with it is that it was agreed that we had to write this letter on the day that the inflation index comes out. So, you know, you either end up with incredibly rapid, agonized emergency letter writing, or you end up with rather bland letters. And I think our feeling is that we ended up with a rather bland exchange of letters, which has mattered over recent years when inflation got to 5%. And that's been changed in the recent adjustments to the monetary policy remit, so that we don't have to, Sarah will correct me, we don't have to write until either the next meeting, I think. Anyway, we have weeks rather than hours to write our letter, and so we promise to improve the art of letter writing. And actually, there's a serious point there. I think this will make for more accountability. What does accountability mean? Ultimately, I think it means society satisfying itself that it does want the regime that it's got, and I really mean the regime. Whether or not it feels there need to be tweaks to that regime, and what kind of people it wants to appoint to these committees. And the interesting bit, perhaps, is the middle bit, what tweaks need to be made to the regime, and there were tweaks made to the monetary regime recently that have clarified various things, including when we're doing unconventional policy, that is something which the government of the day should be comfortable with and that we should be completely transparent about. And I think those were good changes, because we ended up doing things which no one would have envisaged in 1997.
Yeah, on the just letter writing and accountability, in a sense, the fact that you have the quarterly publication of the inflation report, televised press conference, all that stuff, doesn't that in fact cover a lot of the what was previously thought of as the letter's function? That, you know, insofar as you're held accountable, you're as well as the quarterly appearances in front of the Treasury Committee. Those are the sessions when, in practice, you're more likely to be held to account.
Well, yeah, that's true, but the letter has a reply as well.
Yeah.
We don't just write; the Chancellor writes back, and it's open to a Chancellor to say, well, actually, you know, we think you ought to be doing something different. I mean, I was rereading a speech by Robin Lee Pemberton given in 1991 this afternoon about central bank independence, so 6 years before central bank independence came. And he says in it, well, you wouldn't necessarily be able to sustain this in the face of civil disobedience, and you couldn't. We are unelected. The legitimacy of this regime has to be constantly earned. And so every time the Chancellor writes back to us saying, well, that sounds broadly sensible, I'd get on with doing that then. This is a really important thing. This is what, betraying some of my origins, this is a performative utterance in some respects. It's not just a vanilla communication. It is doing something. It is reaffirming the regime. And in that sense, the independence that we have is not isomorphic with, say, the independence that the Bundesbank had, nor with the independence the ECB has. And we've never sought that. We've argued, as Eddie put it, we campaign for stability, not for independence. And then within independence, we've wanted a system where the legitimacy of the regime can continuously be renewed and reaffirmed, or not.
Right. Now, at the back, we've got a number of questions. Lauren, the gentleman there, then there's two at the back. Yeah, exactly.
Robert Morland, I'm a former member of the European Parliament. I'd love to say something on rules, but I agree with Mark, and my question really follows on from that. I would have thought one of the things you must be concerned about is going to be the whole relationship with the banking union and all the changes that are going to be taking place there, whether they're constitutional or otherwise, to absolutely ensure that we're not always inevitably faced with a block vote in terms of the free market on financial services. And if I was in your shoes, I would be worried that now this is going to be in a much wider debate and might be lost in that debate. In other words, there'll be more discussion on the working time directive than anything you've talked about. Is this a matter of concern for you?
Right, and there are two right at the back.
Sam Coates from The Times. It's fascinating that you're talking about accountability. It strikes me as extremely pertinent at the moment. I mean, what I think you've touched on this evening is the fact that you're taking incredibly big, essentially political decisions. One way of thinking about it is you're the guys in charge of the punch bowl. So my first question is, do we really think that just an exchange of letters to and fro is a high enough a degree of accountability? You say that you're accountable to Parliament, but we don't really see a great deal of that apart from very rare incidences in front of the Treasury Select Committee. So isn't there a better way, given the scale of your decisions, that you can do? And secondly, take one example of the punch bowl being taken away. There was some charge this morning that, in fact, the Bank of England is responsible for tipping Britain back towards recession in 2011 when it got rid of the special liquidity scheme some would say too early. Is that a fair charge? And do you think that people should be given more opportunities to participate in that kind of debate?
Right, there's one next to you.
It's Phil Aldrich at the Daily Telegraph. Paul, you've talked about progress being made on towards getting to a point where taxpayers will not be on the hook for bailing out the banks. It feels like there has been progress, but it feels like it's still a very long way away. And I just wondered if you could give us a time frame for when the taxpayer might be off the hook. And could it be 2019 when the Basel III reforms are supposed to be fully implemented? And a quick cheeky one, the chairmanship of Lloyd's is coming free. Is that a job you might be interested in?
Good. Thank you. Also, sorry, before Paul answers, if there's anyone in the next door room who wants to ask a question, Kate could do. And, right, Paul.
Banking union. First thing to say is that, like the government, I think pretty well everybody in this country supports the banking union because our biggest trading partner, our next door neighbour, has got an incomplete economic and monetary union, and it needs to be reformed and solid foundations built, and banking union is part of that. In terms of on the narrow banking bit of it, block voting and I suspect you're thinking of the European Banking Authority and things like that. The Treasury have been quite careful to ensure that there are provisions effectively for double majorities so that can't happen. We will be very attentive to that. But I would also say that big picture, this really is, what I said about there being 4 supervisors in the Western world, the Federal Reserve, the Swiss, the ECB and the Bank of England. If that's true, then there will be less to worry about. It's a bit like now. People will say, we've got to go off to Brussels and negotiate all of these things. Well, actually, often Brussels is implementing or codifying in Europe something that has been agreed globally. It has always been in our interests to reach global agreements. And so far, we have continued to be able to at least punch our weight, and sometimes rather more than our weight, at the global table, and we must ensure that we continue to do so. And that really, although it may seem one remove from Europe, I think it should provide you with a good deal of reassurance, because on the whole, where a good global standard has existed, Europe has wanted to implement it. Where there isn't a global standard, whether it's the United States or Asia or Europe or this country, individual jurisdictions do their own thing. That is a lot more difficult for an international financial centre. On going to accountability, I mean, the more debate, the better. Debate is a necessary precondition for the legitimacy that I talked about to be continuously reaffirmed. There are actually quite a lot of select committee hearings, but we are at their disposal. In some countries, there are fewer select committee hearings. In a few, there are more, but we are simply at the disposal. No one elected us. We are accountable to the people through elected politicians. It is our duty and pleasure, frankly, to appear in front of them and answer their questions, and I am completely serious about that. That is what it is to be an independent central banker. On the last question about the resolution of banks without taxpayer funds, so I think you were agreeing that a good deal of progress has been made. Why hasn't more been made? Well, fundamentally, it's for the profound reason that all resolution regimes, which effectively substitute for liquidation, involve an agency of the state interfering with property rights, and therefore the legislature needs to dwell carefully and thoroughly on that. So at the moment, the key piece of legislation is the resolution directive that is going through Europe. It is being debated in the Council of Ministers. Many of the key principles, in fact, were debated at the G7 meeting of finance ministers and governors hosted in this country recently. It's going through the European Parliament. All of this is in the open air, as some of you in the room who are involved in that debate know. And I think it probably is, although frustrating to some, I think it is probably one of those instances of less haste, more speed, because the legitimacy, I've used the word legitimacy a lot, but I think rightly, the legitimacy of the resolution regime will be embedded only if democratically elected people have satisfied themselves that an agency of the state in this country, us, should have those powers. I'm not going to give you a date, but I promise you this is doable. There is no reason why the largest firms in the world should require taxpayers' money to support them when they are, by definition, highly leveraged, and so there are an awful lot of creditors to take the losses instead. And that means, and I'll perhaps end on this note, that means that you harness market discipline. That's not perfect, but it's better to have the markets working with you than against you. But most elementally, it means that banking becomes part of capitalism. We can't have a financial system where banking is semi-socialized or contingently socialized. That's no way to go on. And this is a problem with a solution that is more than within reach.
Paul, thank you very much indeed. It's been absolutely fascinating, both talk you gave and your response to a diverse range of questions. My apologies to those who couldn't get in and ask their questions on that, but we had a very wide range of questions on that. You showed that your background as both a mathematician and philosopher, as well as a career central banker, in reply to those questions. I'm absolutely delighted we invited you to be the third part of this series. It's been an absolutely fascinating talk. Before I invite the audience to thank you, I'll point out that the fourth and final one in this series is on a week on Thursday with John Brown, Lord Brown, talking more generally about his experiences now. He's the lead non-executive director in government of business and government, which he's written extensively about. And that also will be sponsored by the City Corporation, which I again would like to thank. I'm very glad that Mark Belliat's spoke with introductory remarks at the beginning on that. That'll be the final session on that, which will be, I say, it's the 6th of June. But meanwhile, could I invite you to join me in thanking Paul Tucker, Deputy Governor of the Bank of England, for his speech and his comments this evening. Thank you very much indeed. Thank you. And sorry, there's one final thing. At Institute for Government, we don't take away the punch bowl. As always, there are drinks and some canapes outside for those of you who believe that the punch bowl should still be enjoyed. Thank you.